All right, good morning, everybody. So we had this bias going into the week that the first part of the week would be range bound while we wait for CPI. And so far, it's not too hard to stay range bound inside of Friday's range. Yesterday, selling into strength, buying into weakness, and that worked out fairly well. Not too bad. But there's a bigger issue that is kind of front and center. And it's this situation that the Fed is in. They're kind of trapped. So historically, when they announce a pause, the clock starts ticking and there's kind of a follow through in the market that comes after the Fed announces a pause. And so they didn't want to announce that they were pausing, and they used that funny little skip phrase at the last meeting. But they continued since then to come out and speak and to intonate, wink and nod that they are going to raise rates again and that they're not done. And that's where they leave it. And we've had Fed speakers like yesterday where they continue to beat the drum saying we need to do more. We're not far enough past neutral to be in the mildly restrictive area that they want to be in. The market, on the other hand, is it's showing they're not quite sure about that. And there are a lot of say the Fed is done. They're not going to raise again. And that they're actually going to announce a pause. So the Fed Watch tool for July 26 has the 90, we'll call it 95%. That's in statistical groups, 95% probability is a really high probability, right? I mean, that's up there. That's just really high. So the market, with almost no doubt in its mind whatsoever, believes the Fed is going to raise rates on July 26. 95%. That's a very high certainty. And it's gone up within the last day, right? Between yesterday and today, we went from a 93 to a 94.9. So they're continuing, especially with the Fed yesterday pounding the table, they're continuing to price in the idea that the Fed rates on July 26. But there's still a lot of really smart analysts out there who, they have their own track record for their accuracy, and they're saying the Fed is done. So what gives? CPI data. When we get CPI data this week, it very well could have what the Fed needs to see for them to announce a pause. They haven't announced a pause yet because they're not seeing in the data what they want to see. But if the CPI data tomorrow gives them that missing piece of the puzzle, they could announce a pause, or at least start coming out and hitting the talk shows, right? Maybe running like a full Ginsburg and saying that they now believe that we are in that mildly restrictive territory that they're looking for, which is like a mythical unicorn anyways. How do you know if you're in mildly restrictive territory if you don't know where neutral is? And neutral is just a hypothetical concept. So that makes tomorrow's CPI data just a little bit more impactful, potentially impactful, than it normally would be. right? And it's already a biggie when it comes to, the top 3 economic events that we can get on the calendar. CPI ranks pretty high up there. It's in the top 3. And if you're wondering, well, dang, what are the other 2? CPI, non-farm payrolls, and FOMC itself. Those are the top 3. Yeah, I mean, don't get me wrong, PPI, but PPI is nothing compared to CPI. All right, so tomorrow's going to be the big one. It's if they announce a pause, you're going to see the market unwind all of this, and that's a lot to unwind. And then, of course, there is the historic precedent of usually what happens after the Fed announces that they're going to pause, and all of the drama that comes with that. So the last time we were sitting on the precipice, has that big word early in the morning. The last time we were sitting on this edge, waiting for a big event, and we were talking about the bias that we were going to stay sideways into whatever event that was. You'll remember that I mentioned it doesn't feel right. I don't think we're going to be sideways today, and we weren't. It was the day before an event, and the market expanded into one of those 0-day gotchas where we just ran like a mad demon. So while our baseline bias is that we ain't doing nothing, and that we're going to hold the line and stay in the range, which again, Friday's range is huge, right? Now add Monday's low to that, Friday's high, and this is our range. It's not hard to throw a dart at that target and say, I think we're going to stay inside the range, because it's a huge range. But don't be complacent today. We have the capacity to really move the needle right before this CPI print. All right. So yesterday was kind of easy, especially after we got that high early in the morning. All right. And then that double bottom tweezer bottom later around noon. I mean, a gift, right? Like, thank you. That was a mortgage payment. Appreciate it. So let's do the thing, huh? We have auctions today at 11 and 11:30, and then again at 1 o'clock. They're not my favorites, but I do like that 52 week. It's a biggie. So keep your eye on that one. Do keep in mind that somewhere in the world tonight, there is going to be a PPI report. Of course, we can just click on it and see, hey, what nation is this? It's not going to affect us in our trading day today. And by now, whatever you're holding in your portfolio, I'm hoping you're comfortable with it, because this week is very likely going to be a game changer. We do have some Fed speakers, and the UK is going to be discussing unemployment. The new economic assistance measures out of China helped commodities and equities rise. Yeah, AKA stimulus. We are seeing that weaker dollar. Right? I don't like really saying it that way. We're seeing the dollar decrease, right? It's certainly fading back. A weak dollar is something completely different, right? We kind of put that into its own little box. They're still saying higher for longer, which has no bearing or impact on whether or not they would hike, right? Higher for longer can just say, oh, we're going to stay where we're at. Very likely that they won't cut unless something goes wrong. And a lot of analysts are saying 2025 before they see a cut. Germany's still really pushing. So we look around the world at what's going on, right? And the worst is Japan. It was down a little more than 0.25%. The UK also around that 0.25%. So those two were negative. The rest were either flat or positive on the day. Germany's up 0.5%. Not a bad way to finish up. Watch the clock at 9 o'clock. We got Bullard. All right, so we're going to start out here on the weekly. We're still inside week. We are IX10 at this point, and the box you can run would either be that last week in June, or you can run it all the way back out here to like the first week in June. Either way, we're inside that thing. We've been inside it forever. Eventually, we're going to come out of it like a clown getting shot out of a cannon, but not yet. Right? But look at those moving averages, how they're all fanned out nicely in a fork pattern. That's about as healthy as you can get, right? If you were to look up, the picture of health, it is healthy. So these 2 weeks of pullbacks that we see here are nothing, right? The fact that we've stalled isn't really all that concerning. Consider how much we've moved, right? Since being way down here at 3,600, crossing through the 200 period weekly moving average last year to where we're at now, right? Going from 35 to 45 kind of makes sense. We're going to get a little pause. Or even just from May to June, going from 4,000 to 4,500. So I still want to see that test of the 10. We might get it this week with the kind of volatility that's on the table. You can see back here when we tested that 10 before. Now remember, it's not support and resistance, right? We would never look at a moving average as if it's some kind of support and resistance, right? But it is an area of reaction, because a lot of the institutions and just a lot of firms will use that as a guide. Are we above it? Are we below it? Are they going to pick up more of it? It's average price, basically. It's like the mean, which is old school, because nowadays there's an indicator that is just called average price, and you don't need to use the 10, but whatever. We had a very narrow IB in the overnight. The IB is called initial balance. It's basically the open range between 6 and 7 p.m. It's always a 1 hour open range. If you use anything else, then it's not the IB, right? It's not the initial balance. It can still be an open range. And if you're trading at night, the open range is very useful. It's great. You can use whatever open range you want: 1 minute, 5 minute, 15 minute, 30 minute. But for the IB, the initial balance is 1 hour, and it sets the tone for the evening, usually. implying whether or not they got a lot of work done or if there is still work that needs to be done. So that narrow little strip is the IB. And then we have yesterday's price. And right now we are inside day breakout for the second time. First time failed. We had that run through the kill zone between 2 and 4. And then we ran that back up and closed the gap. Although technically, there wasn't a gap, but whatever. So we got that closed. Basically a reset with a Busby off the IB or off of the VWAP. Either way you want to play that. And it's very likely going to be a choppy, nasty, sideways day. But just in case it turns out to be one of those others, if we do start to rock it out, and it's exactly what happened the last time we were on this hurry up and wait bandwagon, is we ended up with like a 2 standard deviation day. That would put us near the top of this range, right? That previous week's high, 44.94, 44.99, something like that. Or, just to be fair in the bias, all the way down to 4,400 or 43.95, something like that. Now, don't get me wrong, there's a lot of stuff in the middle. We can see that there are daily pivot points and weekly pivot points, and VWAP is in there, and the 21-day average range. So all of that stuff is packed in there too. So far, we've got a missed daily pivot, and we are struggling with getting above the weekly pivot or holding above the weekly pivot. Volume isn't really too light, which kind of fits into the narrative that we could see some trading today. But I mean, it wasn't bad yesterday either, right? I think my approach today is going to be working on zone plays. So the zone right now is, we'll just use that Globex. Because obviously, the IB, while we can look at it and say, wow, man, that was a really narrow IB, we've expanded on both sides of it since then. And so now it really doesn't have any value to us. We've moved through the Globex open so many times, we don't have any value there. And we're bouncing and flirting with that 10-day. And we've crossed through that so many times that there's nothing there. So none of those are going to be any benefit to us or an assistance or help or value at all. So the only thing we got left is whether or not we're above or below the weekly pivot point. And just crossing above it or below it today isn't really going to matter. It's, are we driving, if we stay above it, are we going to continue to drive farther away from it or not? Because, the bias is if you're above the weekly pivot, you want to look for bullish trades. And if you're below the weekly pivot, you want to look for bearish trades. But we have to get far enough away from it for that bias to actually hold. Can't just look at the candle that crosses through it and say, well, now we're bullish. No. So this is going to be the range until the range changes. Be careful, just like yesterday, how we had that wicking out. I thought yesterday was a great textbook example of trap the bears, trap the bulls, right? The trap plays. They have to go far enough through on one side or the other to actually convince people to go long so that they can trap them and then dump it on their head, right? So that breakout yesterday, I got a phrase that says, if we don't break out by 10 a.m., then if we do break out after 10 a.m., it's fake. It's not going to sustain itself. It's going to fall apart. And yesterday was another example of why I say that. Perfect breakout. I mean, it was great, but it was too late. It shouldn't have happened that late in the morning, and it unraveled and fell apart. So that top one, just a great trap for the bulls. And then the bottom one was our own 5-minute open range low. And it went just far enough to convince everybody that, oh yeah, we're going down. Get the bears in there, flip it on their head, rug pull, and up we go. So with the range set for today, very clearly set for today, with that Globex high and Globex low, we have to anticipate that they're going to do a little bit of a rug pull, and that they got to sucker you in, right? They need the liquidity. They got to get you to trade. They need your participation. So a breakout above, maybe stalling around that voodoo line and then coming back down, that would be a nice little trap. And then breaking down below our own Globex low, tangling up with that daily pivot point, and then flipping around, that'd be a nice little trap. But how do we know that it's a trap and that it's not an actual breakout that has legs and follow through? There is a quant tool on Thinkorswim. And if you're on another broker, just use your fib and add these levels, right? So I'm just going to draw it here in the middle of nowhere for a moment. This is the range from 0 to 100. Now on Thinkorswim, the direction you draw it is how you get the lines to go up or down. Okay, so if I draw it starting at the highs and going to the lows, my lines go up. But and I go up, my lines go down. So where you start the drawing is the side that's going to get the lines. If you want your line to go up, start at the top, drag your mouse down. So once you measure a range or whatever it is that you measure, candle learning, they talk about 50%. Everything. So we got 50% of the range marked. And this is just be 50%, right? We take that half and we set it up here. So that's 50%. That's 100%. That's 150%. And you can just keep doing that. 150, 200, 250, 300, 350, 400. And if you don't have the quant tool, like I was mentioning here, then just add those lines to your Fibonacci drawing, right? Because most brokers that have drawing tools are going to have some form of Fibonacci. Just take your Fibonacci. You can see I got 50 sitting up there already. And just add those levels to it. No big deal, right? So now that we discussed how to do it, come back down to the range. And on Thinkorswim, by the way, you can add negative levels. So if you wanted it to plot both directions, but you don't want to draw it twice, just go in there and add curves and put a negative sign in front of those numbers. -1, 0.5, -2, and you'll have them drawn in both directions. So a good rule of thumb that I like to do is use Fibonacci in this range concept. So instead of using the 50, the 100, 150, 200, 250, 300, I also add in the 1, 2, 3, 6 and the 111. The 111 is a little bit of a warning center for me. I notice that when things fail, especially on, say, a breakout, they'll tangle up with that 111 and fail. So I call it the warning center, the word center being that it's in the middle of these two. Not perfect, but, you know, and that it is a warning area. So if we do get a breakout, I'm going to be watching for that 1, 2, 3, 6. If we can get to it first, and then if we get through it and close above it. Now that always screws with new traders when I say close above, because close above on what time frame? Don't play those mind games with yourself, right? Yes, obviously, if I go down into a 1 minute or a 30-second, we could probably close above it pretty easy. Stick to the time frame that you're working with. If you're working on a 1 minute, then that's what you need to close. If it's a 15-minute, then that's what you need to close. Otherwise, a breakout that tangles around the 111 and fades back will be the signal for me for a good short. You can wait for confirmation, right? All those things. Just remember, the longer you wait for confirmation, the more risk you have to put into the trade. It makes the trade less risky, right? Like bungee jumping is a risky endeavor. So waiting for confirmation is less risky, but waiting for confirmation makes you put more dollars at risk. So it's just a personal choice on whether or not you take a trade before you have full confirmation or not. And it'll be the same thing to the downside, whether it's going to be able to expand down below the 111 warning center and get to the 1, 2, 3, 6 or not, which tangles us up perfectly right into the 1, 2, 3, 6 anyways, right? And the daily pivot. $44.53 is a significant level that holds a lot of weight. We'll see if we'll be able to get through that or not. We weren't able to keep it back here, and the bulk of all the volume in those three in that swing high pattern, greatest amount of volume was right there at that 44.53 and a tick in all three of those candles. And you can see in that candle it failed to get through, and in that candle it failed to get through. Right there. Right there. That's turning on the VPOC per candle kind of provides a little insight, right? 10-day, 30-minute volume profile. I mentioned earlier in the week that by Wednesday, unless we get new lows that revisit the 4,400 and maybe the 4,380 area, unless we come down into this zone, 4,400 is going to be the low when we get up tomorrow and come in here and do this all over again, because these candles back here on the right, on the left, excuse me, these will be gone, right? So every time we get a new candle on the right, we lose a candle off the left. I have not counted these up, but let's just use a fun number and say that there are 1,000 candles showing. It's a 10-day, 30-minute. We can see the 30-minute up here. So on a 10-day, 30-minute chart, if we had 1,000 candles, every time we get a new one, we have to lose one. And that way we always maintain that 1,000 candles. Well, once these candles are gone, if we have not broke this low and come down here, then tomorrow our new low will be right there. And then we will have said, when we're at the highs, we go to the lows. When we're at the lows, we go to the highs. And it'll really look like we hit the low and we bounced off of it, but it wasn't the low then when we hit it, just like that wasn't the high when we hit it. Okay. I'm just going to keep going through that every morning until it kind of starts to sink in. We do have an air pocket above us, so we should be able to go through that zone relatively easy, just like we had back here. Right, we moved through that area relatively easy. But there is also an air pocket below us. So if we do break that 44.11 cog line, we should drop down to the 43.80 area relatively easy. And I don't like using the word easy in trading. It doesn't really fit, but you know, a lack of resistance. This is, or it was, starting to be a classic B shape, but now we've got some kind of like, I don't know what that is. So we no longer have a classic profile. If we begin to fill out one of these air pockets on either side, then we could end up with, the lowercase b or the capital P. If we fill both in, obviously we're going to get a D, right? It's those classic profiles. All right, mapping out the 5x5. It's a 5-day, 5-minute chart. Each day gets its own volume profile. Now the textbooks will tell you to carry forward the value area high, the value area low, and the point of control into the next day's trading zone. You could, I don't. I've already got enough pivots that I don't really care about the value area high and low. And when it comes to the point of control, if we haven't hit it, I'm willing to carry it forward. But once we hit it and we close below it, then I'm done with it. And again, on that close below, don't get hung up on your time frames and really kind of just try to recognize why we're looking at it. It's supposed to be an area where there was a greatest amount of volume. Not supposed to be, that's what it is, right? We can look back at the previous day and we can ask the question, where was the greatest amount of volume at by price, right? Because this isn't the TPO, it's the volume profile. So we're asking volume by price. Where's the greatest amount of volume at? 44.38. So when we get back to that level, will it still be the area of a lot of trading activity? And there's one that we need to take off, right? Because we hit it yesterday. And you can see how price interacted with it. It went through that area because it's not support and resistance, but it is where price stalled and there was a reaction in the market and we failed to maintain above it, right? We just dumped back down again. So it's not support, it's not resistance. It very likely won't even offer you a first touch play, but it is an area of concern. So that if I was looking to take a trade, say I got in on these lows and I'm running it up and now it breaks out of that 5-minute candle and we're continuing to expand and I can see that there's a VPOC overhead, I'm going to take some off as we get closer into that area on the concern that we might not make it through that area. And if I wasn't in at all yet, if I hadn't got in on those lows and instead was trying to trade the breakout, you could see it. It's like a 2-point move, maybe 2.5 points from the breakout to the VPOC. You wouldn't want to take the breakout. There's just not enough room for profit. So everybody uses them their own way. If you can see that there's a roadblock in front of you, you probably want to hold your trade until after that roadblock is dealt with. And then you get your trade. We just got a new high on the morning. Not enough. Okay. Looking at the week. So right now we're on a daily chart. It's 1 year daily. These levels were drawn the Friday before. So on this Friday, these lines were drawn, and after the close, they were set in stone. Then we got Monday and now Tuesday. We're not very far away from where we started, which makes sense because we're all waiting on that CPI print. And the high of the week, this weekly expected move range, lines up really well with the high of this pivot up here. Right? It's not perfect, just, you know, a liquidity zone. So at 4,500 plus it's a gamma level. And we're still 2.3% above the 10-week. And as long as we're maintaining above the 10-week, we're considered to be in a healthy market, strong market. If we take off and go silly today, like we did the last time we were all on this hurry up and wait scenario, we could hit the edge of the weekly expected move today. And that would be my baseline bet. So watch the options flows, the 0-day flows. If everything starts to get wild, some 0-day butterflies up at around 44.91 are probably going to cost you around 50 cents or so, maybe 75 cents. But it'll pay you out probably 15, maybe $18. You want a conversion on that. We're talking about risking about $75 to make, you know, $1,500 ish. Just remember though, the baseline bet is still that we're going to hold the range like we did yesterday and not really do anything while we wait for CPI. And CPI is tomorrow morning at 8:30. All right, so they're going to try to continue to fake people out just like yesterday. And what we did yesterday, sell into strength, buy into weakness, play the edges, and just leave the rest alone. Otherwise, trying to trade in that, you're very likely just going to get chewed up, right? Trying to trade the middle of that. Now we can look at what's moving around, but I don't have a lot of faith that we're going to find much other than this capital rotation that's going around, right? Okay, so we got Bitcoin down. That means the Bitcoin proxies are going to be down. Riot, Mara, Coin. Let's go see what those look like. Well, Mara made it all the way to its measured move. This is a great example of that warning center. So There we hit the warning center and we pulled back to the 786. It found some support there, made a run for it again, got tangled up in the warning center, pulled back, finally made it through there. Took a while, but it got there. You know, the really cool thing is that you can use these quant tools and Fibonacci levels, whatever. You just make your own stuff. As long as you can validate it, prove that it works, and then stay consistent with how you're using it, you can do whatever you want, which is why I made my own stuff. It works. Mara is down, but it's barely down. Closed at 1692 and we're sitting at 1672. So we're just slightly down. And I'd rather open slightly down rather than open gapped up, right? You can see like when we closed there and we opened gapped up and tried to get an inside day breakout and failed, and then got an inside day breakout to the bottom and that failed, and then it rallied back up again. So this morning we're opening just slightly down. If you're looking for a rebound continuation in the Bitcoin proxies, then use 50% of yesterday for your line in the sand. What the heck is, don't want that. Needs to hold above 1611. And what would be good is if we could get a little bit of a bounce, right? So say a fade down, bounce on that, and then a rally up and a breakout. Just keep in mind after that really big cup, and now we formed the ladle, there's every expectation that we pause at this point. And Riot, which has just gone goofy crazy. It's only down 20 cents this morning, so barely down at all. If we get a little bit of a fade, today's 1637 for support and still target 1884. All right, JetBlue's at that significant resistance level. It's been unable to get past that 9.25, 9.5. It's basically the 50% mark of that candle. Can't seem to get through it. So if we do get through it, then we'll target that round number of $10. Could get a little overshoot 1093, but I mean, look at the exaggerated move on this thing. The size of these candles versus the average candle size. I'm talking about a 3, 4, 5 times the average. We're down this morning to around 907. So lower than 50% of yesterday's candle. That's bearish. We're looking for a short-term short. Maybe a rally into $911. Hit our head on that, and then a break down below 892 with a target of these lows 8.7, 8.6. Right, probably I wouldn't try to I don't think its options are that good. Oh yeah, no, never mind. You should be all right. Just stay in the front end, less than 30 days, less than 20 days, really. Yeah, they're not that great. You'd probably be better off using a different product. Let's go check another airline. Yeah, that'll do the stock, but shorting stock is rather use options. Monthly TRB, massive breakout on Delta. That's not helpful. So we got 48.63 this morning. The airlines are up just a little bit. We are inside day breakout on Delta Airlines. If we continue to move to the upside, then near the bell, maybe get a little bit of a retrace, right? If we can retrace to 48.46, get a bounce off of the close, or 48.61, which would be a bounce off of yesterday's high. I'd like some kind of a bounce first. I don't like a gapped up market for a bullish move if the gap isn't very big. So we can see this gap over here after this massive day, right? We had this huge run. We closed, gapped up the next day. We came back down and closed that gap. And then we stayed bullish, right? So that's what we're looking for. Just a little bit of a fade, a little bounce. And since today is a day that didn't come after a really big move, we could get a really big move, right? We wouldn't expect two really big move days in a row. So we're IX10, we have the capacity for a breakout. And if we break out, we could get one of these really big candle days. But we need to get it, right? So nice, it's lined up. It has primed it up for us perfectly. We just need a little bit of a fade, catch a bounce, get the breakout above 49. Bob's your uncle. There's a lot of trash up there. I think it's going to be really hard for this thing to continue to drive. There is a gap that needs closed at 2020. And I mean, that's it. There's a gap that needs closed. $19.50 is about as good as it gets. And we closed at 18.57. We're sitting at 18.65. So, we're just slightly up this morning. So at the very least, we know we got airlines. All right, so someone was asking for clarification on what I was talking about with the SPX. Back in 2019, I put a bunch of strategies together that work on using these lines: iron condor strategies, butterflies, verticals, whether credit spreads or debit spreads, calls, puts, just straight up buying options on the edges. And those strategies worked pretty good, except for the sell side stuff, like the iron condors. The ranges now, after COVID, are so wide that if we build the iron condors on the lines like we were doing before COVID, that you don't get any credit for them, right? You're building the iron so far out that you're getting like 10 cents on the dollar. So you're risking 90 cents to make 10 cents. And if you don't manage that thing for its max profit, meaning hold it for the whole week, then you're never going to make enough money to pay off the one single time that you lose, right? So you could have a 90% win rate doing that, win 9 out of 10 trades, but that one loser will wipe out all your profits plus some. So we can't do the iron condor strategy because it's just these boxes are still just too wide. But we can still do the butterflies. And the SPX closes on this line, on any of these three lines, way more than it statistically should. It's nearly a $4,500 product, and yet it will pin to the line, to the T, more than it should. They're calling these lines out Friday of last week, and yet we might close on there Monday, Tuesday, Wednesday, or even just hit the lines, right? Especially in the later part of the day, like say on Thursday, where we hit the edge. You can see last week, a couple of weeks back, where we hit the lines 3 days in a row. Now closing on the line is what I'm talking about. And if we start to expand today, just today, getting a 0-day butterfly, you just put the butterfly on the line, up or down. I think up, because if we get a gamma squeeze today, it would drive us right up in and pin to that 44.90. Now butterflies only pay you if the conditions are met: time and price. So just because price goes to the line, that won't pay it. If we go there at like 10:30, we need to get there at like 2:30. So we need 44.90. We come in and look at 44.90. And we can see how cheap they are, right? And in fact, some of this is just bag holders. These zeros and fives, this is a nickel product, so you can't get penny size increments in the SPX. You have to pay a nickel at the very least. So you never get a trade in here like an iron condor or a butterfly or whatever you're doing. You're not going to get one for a penny or 3 cents. So 44.90, we'll build it and see if it puts us where we're getting some bag holders or not. 44.95, yeah, it's trash, but we don't really have much choice on that upper one. All of these are the same price, and they have some open interest. So, maybe that's going to be the harder ones, right? Getting filled on those, getting this thing filled might be a little difficult as a unit. You might have to leg into this butterfly just because we're so far out. Now, remember, the market's not open yet, obviously. And these might have something to them when we finally open up, right? So they're junk now, but they don't represent real value. And that's fine because we know that going into it. So that's the butterfly. It shouldn't be at a credit. It's only showing a credit because these are trash. So if we, at the bare minimum, were to open this for 5 cents, what's your max risk? 5 cents. Now, this is the smallest one possible, and its max profit, if we were to throw it into the analyzer, is around probably $4.95, right? Because it's a $5 wide spread and we're risking $5. That would be $4.95 profit max. but I didn't make this any bigger, right? So $495 max profit if you pinned it right in the middle. But I'd say widen it out because it's so cheap. I mentioned risking about $75. If we were to widen this thing 40 points to the downside and 40 points to the upside, now we're risking about $70. The tent that we need to land in has widened also, right? We had this narrow window that we needed to pin to. Now we've got much more room. As long as it closes anywhere inside of these two lines, you'll have some form of profit. You're risking about $75, $80 for a chance to make around $3,900. Now, to be fair, pinning in the middle and making $3,900, you have probably the same chance of winning the Powerball, right? Snowball's chance in hell. But I aim for about half of that. If this says I could make 4,000, 2,000 is a reasonable estimate. And if it says I'm risking 80, 60 is a reasonable estimate because I don't have to run it all the way to zero, right? If we fall to the downside first thing in the morning and I just put this thing on, there's no reason to run it to zero. Go ahead and close it, take a $20, $30 loss and walk away like whatever. I thought we were going up. We're not. Let it go. So the max loss is 80, but I'm not seeing any reason to eat the full $80 loss, and we're risking some of that 80 to make some of this 4,000. It's not a bad way to go. Now the problem with butterflies is they have like a 10% win rate. Statistically, if you were to do short dated butterflies, the win rate is around 10, maybe 20%. But if you're using those lines, you increase your chances of winning 200%. So instead of having a 10% chance, you have more like a 30 to 35% chance. I ran weekly butterflies in 2019 for the entire year. My win rate stayed in the high 60s. And for a short dated butterfly, that's phenomenal. And I made way more money than I lost. The problem with this strategy is you will lose frequently. And some people just can't tolerate that. They just cannot stomach taking a losing trade. You know, those I have to win kind of people. So if you're one of those I have to win kind of people, don't do this strategy because you are going to lose 7 out of 10 trades at least. It sucks. It sucks. The losses aren't big. It's just that psychological thing of lose, lose again, 8, 9, 10, 11, 12 times in a row before you finally get that winner. But when you do get the winner, oh, it's nice. Like that one right there. That would have pinned. That's just one time, right? Oh, gee, a Friday close right on the line. But you can do a butterfly Monday through Friday. You don't have to do it in the SPX, but I like doing it in the SPX because I can risk $5 here, 5 pennies. I can risk it here and make $4.95, or I can risk 5 pennies on SPY and make 95. Well, I'd rather make $4.95 for my $5 risk than make 95 for my $5 risk. And you can do the top and the bottom, and you can do Monday, Tuesday, Wednesday, Thursday, Friday. So, I mean, you know, why not? If you want to know the accuracy of pinning on the line, just look at the indicator and zoom into your chart kind of tight and go back and start counting. How many times did we hit the line? How many times did we close on the line? How close to the line do we have to close for your butterfly to be profitable? And just count back. Write it down as you go. Go back as far as you want. And you can get some statistics on how many times you would need to play before you get a winner. Yeah, I'm gonna get off of here, guys. Be careful, be safe, have a good one. And remember that tomorrow is CPI. So no matter how good a trade looks today for swing trades, just ask yourself if you really want to open a new swing trade today that might get completely annihilated tomorrow.